Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. You know, the role and benefits of alternative assets and what those benefits are and what they bring to investment portfolios are becoming more widely known. You know, additionally, accessibility has increased as innovation has made it easier for investors to gain access to alternatives through different investment vehicles, such as ETFs. You know, I have on an industry expert to share his insights into the world of alternatives and how investing in alternatives through ETFs has impacted investing in alternatives. But first, today's episode is sponsored by the award-winning Zephyr, which helps investment professionals make more informed investment decisions on behalf of their clients. I am very honored and excited to welcome Dan Petersen. Dan is the Director of Product Management at New York Life Investments. Dan, thank you so much for coming on the show. It's such an honor to have you on. Can you please tell us a little bit more about yourself and New York Life Investments?
Sure. Thanks, Ryan. I really appreciate you having me on. So I've been with the company for a little over 12 years now, working with liquid alternatives the entire time. So hopefully we can really dig through the topic a bit without going over anybody's heads, right? We'll keep it as easy to digest as possible. But New York Life Investments, just for a brief background, people have heard of Mainstay in the past, right? NYLI is diversified global asset management firm with, as of last quarter, about 750 billion in assets under management. And the goal here is we're basically invested in our clients' success with guidance, resources, and investment solutions that reflect the diverse perspectives of the boutiques of the company. So over the years, we've built out a collection of boutique asset managers to offer a wide array of expertise, resulting in a broad spectrum of best-in-class strategies across multiple market segments. It's been almost 10 years since the acquisition of Index IQ ETFs, which is actually where I came to NYLI.
Okay.
Some of those ETFs include the liquid alternatives, which go back to 2009, which means that we have the longest track record, also still the largest ETFs in the liquid alternative space. ETFs have since become a brand within NYLI, so you'll see NYLI on all of the ETFs. And we've expanded the lineup to include successful currency neutral strategy, which maybe in a future podcast, we can get into that. An interesting adjusted for risk discussion there. Competitive active fixed income strategies, including a couple of municipals, and also launched a few equity strategies in conjunction with some of the boutiques within the company.
Awesome, Dan. Yeah, I'd love to talk more about active ETFs. They're so popular now too. You know, let's just start. I love that you have so much experience in liquid alts. It's another place that has gained so much experience, and let's just start there real quickly. Give us a quick recap of liquid alternatives. And yes, it might go over my head or some of this conversation, like you said. So that's why I'm here, just to get questions answered. But if you could just start there, what is a liquid alternative?
So liquid alternatives are pretty much, as the name suggests, right, an alternative exposure in a liquid form. I think when a lot of people think of alternatives, they think of hedge funds, they think of private investment vehicles. In a liquid form, I mean, we're just making it more accessible to common retail investors and breaking down some of the barriers that you'd find in the prior form, right? What we've seen over the tens of years in the past, inaccessible nature to some, high expenses, maybe a lack of transparency, lockups, right? Illiquidity. A lot of times, investment managers in the private space kind of put gates around how much, how often you can take assets out of the vehicle. So that changes the perception of what you're getting into and the desire to get into it. So some see that as an advantage and some see that as a disadvantage. The liquid alternative side simply democratizes it a bit for those that are concerned about those limitations on the old structure of alternatives.
Fantastic. Thank you for that, Dan. You know, for years, You usually think in like the liquid alternative space or alternative space, you go to mutual funds to get exposure. If a financial advisor wants to add it to a portfolio, it's was typically through a mutual fund or maybe a limited partnership or something like that. Well, now ETFs, which are arguably one of the most popular investment vehicles for financial advisors, and the different types of ETFs continue to expand. I think every day it's like a different type of ETF, very exotic, or, you know, I love the ETF that shorts Jim Cramer's recommendations. They're just a wild array of ETFs. And it's great, I think, for investors to have such a wide selection. But now we're offering alternatives in ETF wrappers, which are becoming very powerful or popular. What will be the impact on alternatives now that alternatives are available in that ETF wrapper?
I think the impact to alternatives, and I'm hoping the impact to alternatives is that investors and advisors become more aware of what they actually are. Maybe we can see increased utilization of alternatives, right? But that's kind of my hope of what the impact to alternatives as a space would be.
Okay.
But I guess the question also angles towards what is the impact towards the old school or the perceived notion of what alternatives have always been available in.
Mm.
And there, I don't think there's much change. If you look at hedge fund AUM, it's grown over the past 10 years. There really hasn't been much of an impact. And again, this isn't brand new. We've been around since 2009. And as you mentioned, there are mutual funds out there that have definitely employed active, alternative exposures. I'm going to say back to the 80s. I mean, there are some mutual funds out there that do merger arbitrage, go back pretty far on track record. And that's an example of an alternative exposure. Um, but what we're looking at here is maybe redefining what an alternative is, or defining what an alternative is. Right? It is not an alternative. Doesn't have to be illiquid. That's not necessarily the description of what an alternative is. An alternative is simply a different risk premia. Right? If I maybe we nerd out and we go back to CAPM and we look at Fama French and we say, equities exhibit some type of relationship to the broad equity markets, right? There's individual company risk if we have an earnings announcement or something like that, but there is an identifiable level of impact that if the market's just up 1% in a day, other companies are up just by very nature of markets having a good day, right? The beta to the market.
Yep.
Um, in that sense, you can kind of increase and decrease your beta depending on what types of companies you want to look into and what their relationship is to the broader market. An alternative is simply an alternative to that thought process. Maybe I'm looking at, I just mentioned merger arbitrage, right? That's a whole different type of risk. It almost doesn't matter what the market does that day. Merger arbitrage, you're investing in announced deals basically moving towards their target price. If company A is buying company B at $80 per share, after the announcement, it might trade at 77, and you're just looking to complete that last part of the deal, right? You're buying in at 77, let's say, and you're riding that last $3. And the movement of the price after that announcement really has nothing to do with what the Fed does, where rates are going, what's happening in the equity market, a geopolitical risk. It just matters that that deal completes successfully. And as that time comes and as the documents get signed and the market starts to accept that, hey, this is going to happen, you gradually go from that pre-deal price to the completion target price. And that's a totally different type of risk than you would see pretty much in any other equity. So it's interesting. If you look at merger arbitrage, you're in small and mid cap companies with a volatility of 5% per year, give or take. That's weird, right?
Yeah.
And it's because these are announced deals. You have a target price, which is almost like a par value of a bond, and you're buying at a discount. So you're simply just completing that little movement with some decent downside. So this is where things get different, and education needs to be had here. Is that I'm looking for a $3 gain on my 77 in that example. What happens if the deal fails? Now I'm back down to that pre-announcement price of 65 or whatever it was. It's big downside potential. And that's why we feel an index type of exposure or passive exposure that gives you a broad access to deal premium in general and what's happening in that space might be an interesting way to approach that, especially from a retail side. rather than looking at an individual manager and what their approach is to try to add value there.
Dan, that is fantastic. I often talk sometimes about misconceptions of different investments, and you just hit it right on the head there with about alternatives. And alternatives, it's such a broad term, right? And you think of just and you brought up, arbitrage, and there are so many different types of alternatives. A lot of time we just kind of focus on real estate or private equity, but the amount of different alternatives out there. And I love it how you mentioned, you know, you just don't think of it being illiquid. Are there any other misconceptions maybe that we think about when we think of alternatives?
This is interesting because it might not be a pitch for liquid alternatives, right? I look at illiquidity. I think most people would think illiquidity. Who wants that, right?
Yeah.
There's an advantage to illiquidity. If you think about all the conversations that have with traditional asset management, right? What is kind of the overarching theme is, hey, it's time in the market, not timing the market, right? Stay the course, and on paper, of course, that makes a ton of sense. But
Yeah.
go into the financial crisis, go into the tech crash, go into 2022, and it's not that easy, right? You kind of get the feeling of, oh, let me get out of here for a minute. I'll get back in when the time is right. But look at the COVID drawdown. The COVID drawdown was 3, 4 weeks, and then all of a sudden, hockey stick back up. So timing these things are tough, and this is where I think illiquidity actually can have an advantage. You mentioned private equity. Just think about private equity for a second. A hedge fund might put money into a firm that is non-public. You have shares outstanding, you have information, you have revenue, you know what your costs are and things like that. But can you really put a value to the per share, price of what that equity should be? Do we know what that company is really going to sell for today? We don't, right? Private equity, we're looking a few years out. The money is invested in this company. The hope is that provides a decent return. And we're going to try to value the equity along the way. But the bottom line is it's very difficult to tell. And all you can really do is, I don't know, every month, whatever the frequency might be, kind of say, we think it's worth this. And, if COVID happens, we're not going to just update that price and say, knock off 20%. We're going to kind of keep the price stable and let it move along. So if you think about this, the public markets, right, the cap spectrum, as you go down in size, you kind of increase your volatility. Small caps can be, higher volatility, could provide more returns, but you expect higher volatility there. Private equity, you're like sub small cap, right? You're really introductory, business type of investment here. So you'd expect the volatility to be off the charts
Yeah.
compared to public equities. But here it is. You're showing a volatility that's almost lower than large caps at times, and it's strange, right? For that reason, there have been attempts and research to try to say, hey, maybe there's a public way to replicate what private equity is doing with really small and micro cap companies on the growth side, and we can try to rejigger a similar approach on the public side. You'll never match the volatility. So you can say you're replicating the returns, but volatility is going to be off the charts, and your risk adjusted return, right, is not going to be as nice as private equity. So that's a tough one to replicate in the
Yeah.
public side.
Yeah, I have a lot of conversations with people about alternatives, rightfully so, because it's a popular space right now. And you, it's such a great point about being illiquid. Maybe that's not such a bad thing because, like you said, being invested in the long term is a lot easier said than done. All right, especially when there's volatility and emotions and all that stuff. Being illiquid forces you to be invested in the long term, which we all talk about, look at the long term, not the short term. So great point. And you talked about illiquid and ETFs being liquid. Obviously they're and have the experience in liquid alternatives, but how does it work when you have an illiquid alternative and you place it in a liquid vehicle like an ETF? How does that work? Obviously it does because we're seeing more do it. Can you add some more color there?
Yeah. So again, I think the illiquid side is just not suitable for a public, liquid alternative because you can't do it, right? So There are some interesting approaches right now happening where there are partnerships with private equity firms, and they're trying to build an ETF that may have some, private exposures in it. But the 40 Act is very explicit in stating that you can only have so much exposure to illiquid holdings in
Hmm.
a liquid 40 Act fund. And I mean, honestly, there are so many different hedge fund styles out there. Maybe the illiquid stuff should stay in the illiquid vehicle, right? And then the liquid approaches might make more sense in a liquid alternative. Because again, when we pull back 30,000 feet, you can look at this as the old ETF versus mutual fund conversation, which we had, at the start of this. Mutual funds generally were the active management space. I know Vanguard kind of made their
Yeah.
entryway with passive, but generally, you look at a mutual fund, you say, okay, tell me about this manager. What's the track record? What's their process? Tell me more about what they look for and do and their research they conduct. And that, I think, lives on in hedge fund world, particularly with the illiquid stuff, and those investors that are kind of that have large assets and they're putting a large chunk into it with the idea that I'm going to commit this for the long term. But then there are other risk premia, right? We spoke about deal risk.
Hmm.
Long short equity might be another one, right? If I were to name two similar companies, Coke and Pepsi, I think are the kind of age old example of long short. Coke and Pepsi should generally move up together, move down together
Yeah.
because they're similar industry, similar products, similar headwinds and tailwinds in the market, and market beta and all that good stuff. So if Coke all of a sudden starts to really outperform Pepsi and there's a divergence there, what's going on? Is probably individual company reason, risk. Um, well researched, we can say maybe that divergence should come back, and I can short the outperformer. If the outperformer is Coke, I can short Coke. Those short proceeds will fund my long in Pepsi, and all I care about is the divergence coming back and converging again. If everything goes up, my short loses money, my long gains money, I'm offset. There's no kind of co-movement or correlation with the markets. It's really more isolated to that divergence
Yeah.
converging. The divergence continues to go out, I lose money. If it converges, no matter which direction, up or down, so long as that gap closes, I make money. So what's my risk here? My risk is that the view that this convergence happens. And that's also where my return comes from. It doesn't come from rates. It doesn't come from equity market movements. It doesn't come from Fed policy or geopolitical stuff. It just comes from that strategy completing. There are, all sorts of examples, right? So we have merger arb, we have long short. Um, there are carry trades where you're long one currency and short another currency, and you're looking for rates to kind of come together. All sorts of public approaches to alternatives where I can say, I'm starting to introduce all of these different types of risks to drive return. Does that make sense to introduce into my portfolio? And I think there's an argument as we learn more and more about this and develop more content around this, that there could be a case made here, for liquid alternatives. I think to your point, we can't include everything. We can't include the illiquid stuff, but there's a lot on the table on the liquid side that you can include.
What you were talking about, it just brought back to what you mentioned at the beginning, diversification, right? So much right now, whether you think it's overdone or not, is driven by Fed policy, interest rates, the uncertainty there. It's great to be able to diversify that out and hedge against a potential Fed mistake, right? And do investments that you just talked about, long, short, that doesn't have the Fed policy interest rates don't really impact it. I think that is so attractive to include something like that in an investment portfolio where obviously fixed income is driven by interest rates. And now, I think equities are more so driven by yields and interest rates more so than ever. So great point there about portfolio diversification and using different types of alternatives that hedge away that macro uncertainty. So the benefits of using ETFs is widely known. We all know the benefits of ETFs, and we're now getting more aware of the benefits of alternatives in investment portfolios. Let's put those two together. What are the benefits of gaining access to alternatives through indexing or through ETFs, and what are those benefits to and you kind of mentioned it, to investment portfolios.
And so it's exactly to your point. If I were to maybe come up with some examples, right? And again, I was with Index IQ back in 2012, and nobody wanted rates to go up, but that was a big argument. Is a low volatility alternative, right? Let's take an example of fixed income in general, right? If we were to look at some broad fixed income index like the aggregate bond index, you can look at an aggregate bond index as having maybe a 5 to 7% standard deviation, and that actually is a range. It's been higher because of what's happened over the past few years. The long-term numbers are closer to 5, whereas the recent term numbers are closer to 7. So that is range bound, and it's well understood why it's range bound. If rate policy goes to zero and it's stuck at zero for a long time, and all you have is yield curve flattening, so it even further promotes duration exposure, you have a low volatility, pretty good returner, right? And fixed income is heroic in 2012 through 2016 or so, when the Fed first tried to raise rates. If I look at an alternative like multi-strategy, let's say, also is about 5 to 7% standard deviation. I know that to your point, fixed income exposure is mostly dependent on duration. There's some credit risk in there too, but duration is pretty obvious, right? When rates go up, you see the price react downward, and vice versa. Multi-strategy, though, if I'm including those merger arb exposures and long short equity exposures and carry trade exposures and fixed income arbitrage, and list all the different types of risk premia, sure, there will amount some duration risk in there,
Mm-hmm.
but it's not a very discrete lever. If my duration is 2, and rates go up, I actually might go up along with it, because there's so many differentiating risks in there that it offsets that actual duration figure that's in there, because there are equities, there are volatility exposures and tail risk premium and things like that. So it's interesting to see it play out in real time. And even in 16 through 18, the bond market didn't react the way everyone thought it would, because
Yeah.
it was mostly short term, and then all of a sudden it just railed back down to zero with COVID. But 2020, end of 21 and 22 in particular, it was game on for rising rates, and everyone saw the pain there. And think about that for a second. You have the Fed coming out and saying, we're going to raise rates, inflation is high, this is what's happening, right? And
Mm-hmm.
it took a while for the market to really digest that, but man, it happened.
Yeah.
Um, we saw fixed income be challenging, and everybody knew it was going to be challenging for a little while. But what do? You have a 5 to 7% standard deviation. This is the conservative side of my portfolio. Maybe I have a 60-40 mix, right? And 40% is conservative fixed income. What do I do here? I know duration is going to hurt me. How
Mm-hmm.
is this conservative if it's going to lose money? Is it conservative? Or are there other ways to get that low volatility without relying on duration risk in particular? And that's where really the benefits of alternatives come through. It's a way to diversify. You just said it, diversify risk in the portfolio. So as long as we can start to understand what these risks are, and not be surprised by them, right? I mean, deal risk can happen.
Yeah.
These long short risks can sometimes go the wrong way for a little while. So it's not a guarantee absolute return all the time. Overall, you're going to have an expectation, just like fixed income. You overall have an expectation. You don't sell out of all your bonds in early 22 because rates are going up. You stay the course, and you weather through it. But can you do that in a more diversified way? And I think that's, to your point, where it really helps. One last point on ETFs. Um, I love that you said everyone knows the benefits of it, but I feel like we're constantly telling again what the benefits are of ETFs. ETFs are a little bit advantaged versus other liquid strategies in their potential to handle capital gains exposure. Not a guarantee whatsoever, but when you have a high turnover strategy like merger arbitrage, and you have an ability to handle capital gains exposure, merger arbitrage in particular, deals close on average every 120 days. So if you
Okay.
think about a collection of deals, you're turning over almost 3 times per year. 300% turnover on a low volatility strategy can hurt. Uh, Collecting little gains along the way, right? All these short-term gains. So this is where the advantages of an ETF structure can actually help out as well. So you not only have the liquidity, I mean, ultra liquidity, because it's intraday liquidity versus mutual fund that trades at 4 p.m., but also these tax advantages. So you can almost, on the liquid side, kind of have these advantages and disadvantages to structure as well.
I love it. It's a great way of, great example of a benefit of ETFs on that taxable side and internal capital gains uh, through, through just a different vehicle, right? And I love it. Great example there. And you talked about expectations. Financial advisors have to, they have expectations really for everything. When setting expectations for alternative ETFs or liquid alternative ETFs, what can financial advisors achieve and not achieve when incorporating these liquid alternative ETFs?
Yeah, I think you basically look at hedge fund index returns. And again, maybe that's because that's what my experience is, right? Our approach is to replicate hedge fund indexes rather than deploy an actively managed individual manager approach to alternatives. And there are some funds that, maybe had a prior hedge fund manager trying to implement their approach. So there are some active managed alternative vehicles out there. But at the index level, I think to your point, you look at what the history has been in various market stressors, and what the advantage is for different strategies. So a multi-strategy, again, a multitude of different types of risks. So you kind of look at the very long-term strategic outlook. I know what my standard deviation range is at that 5 to 7%, similar to fixed income. I don't look at a yield like I would fixed income, though, right? I'm not saying with this standard deviation, I expect this yield, which in fixed income is more dependent on prevailing rates. But in alternatives, it's not a yield focused approach. There can be a yield that comes out of it, but you're looking more at the total return and standard deviation. So Sharpe ratio wise, it actually is similar to fixed income. You have that 5 to 7% standard deviation. The expected return is also a function of risk free. So in higher rate environments, you do expect a higher return out of alternatives. And you're probably looking at 3 to 5% over risk free as a performance expectation, which in a zero interest rate environment, when curves are flattening and fixed income's giving you near double digit returns, it's hard to look at an alternative that gives you 3 to 5 over zero. Yeah, with a similar standard deviation. So that's why I think fixed income and alternatives coexist very well together, even though they're alternatives to each other. But as rates rise, and if you think, back to that merger arb example, if I'm, again, buying into a deal that's going to close at, let's say, $80 a share, and I'm getting it at 77, that $3 needs to be better than risk free. Otherwise, I would just put my money in the bank.
Yeah.
Right. So that's where that kind of comes into play on alternatives is the return on the risk needs to be better than putting cash in the bank account.
Exactly. Fantastic. Moving forward, we've talked a lot about the benefits of alternative ETFs. What are some headwinds moving forward? Obviously, it can't all be benefits. There's no free lunches in this industry. So what are some headwinds moving forward?
The headwinds to my thought process here is really what I've experienced over the past 12 years, and that's digesting, what the expectations are, and really looking at this from a higher level, and not digging into the weeds of, oh, what deal are you in? I saw this on CNBC. What's your position on this? And if we're getting broad exposure to deal premia as a whole, you're looking at it more as to what has that done in the past and what should I expect out of it going forward. I think what ends up happening is people start to get interested in the idea, and then they start to really dig in, and they might be better suited for an active manager in that sense, right? There multi-strategy has so many different risks playing out in there. It can be hard to digest as to what it all means. Do I want every type of risk in this thing? Do I want deal risk and long short risk and fixed income arbitrage risk and carry trade risk? And what is all this stuff? I don't have time to really think about this through. It's too much floating around. There's a Pandora's box, right? There's the hope, and then there's all the stuff that starts flying out, and you say, I don't know if I can explain all this to my client, right? And that's where I think the headwinds are, is really trying to package this up into something where you say, hey, look, there's a lot going on in here. We can dive into it, but we should start high level, and we should say, what are the expectations? What is what is a risk here, broadly speaking? What is my risk compared to the market with similar standard deviation, and take it from there for more of an asset allocation approach. And then if you want to dig in deeper for a particular example, let's do that, right? Let's have a conversation. I think that's the headwind, right? Is there's a lot to digest. This is a whole, almost another universe to get into.
You brought up a good point, and we talked about at the beginning too, like how broad alternatives are, and with innovation there's just so many more alternatives available to the retail client investor. Client communication is so important. How do you communicate this? And I love the fact that you said keep it high level, talk about the asset allocation, the impacts that it has on the investment portfolio, on your client's investment portfolio, versus getting into the weeds. But with that being said, you also got to know what you're investing into, right? But so it is complex, but that client communication is so important. Lastly, real quick, why, yeah, I'm a financial advisor, I'm looking at a liquid alternative ETF, which seems easy, has a ticker, or do I go with a hedge fund? You know, why would I choose a liquid alternative ETF versus a hedge fund to get exposure here?
I think there's an argument for both, but there are some advantages, even just in execution, right? I think as a financial advisor, most client accounts, it's easier to buy an ETF or a mutual fund in than doing the extra paperwork for a private fund.
Mm-hmm.
There's also tax implications beyond capital gains. A lot of limited partnership structures can generate a K1. There used to be some ETFs that had K1s. I don't know if they still exist, but nobody wants to deal with a K1 because they end up coming out sometimes after you want to file the taxes, and it pose all sorts of other complexities into the fray. So I think it's really a decision of what your intent is with the exposure. Do you want a particular active hedge fund manager that you know the process of and you want to be a part of, or are you just looking for the asset allocation kind of index level exposure? We've seen over the years a lot of assets go towards ETFs for that passive index exposure. I think that's really where the alternative opportunity lives for ETFs. Is again just that kind of passive, low cost, transparent. I know what I'm getting. I can pull a methodology document and look at exactly what the process is. Any day of the week, I can go on the website and see exactly what the holdings are. There's a lot there for a retail investor. Whereas I think there's definitely an audience for the traditional hedge fund structure as well.
Fantastic. Transparency is key, right? Especially now, investors are demanding more transparency than ever before. So, very important there. Dan, thank you so much for coming on the show. It's such a fun conversation. You dropped a lot of information, knowledge. It might have went over my head, some of it, but I know our guests are going to take a lot from it. It was fantastic. I loved it. It was an honor and privilege to have you on. Where can our audience get more information about New York Life investments?
Absolutely. And I appreciate being on. The website is nylinvestments.com/ETF to get to the ETF section of the website and learn more there. I'm also trying to become a little bit more active on the social media side. So on x.com, it's D Petersen IQ.
Okay.
Feel free to give a follow there, and I'll crank out more content as the followers increase, and also LinkedIn as well. We try to get some content down on also.
Fantastic, Dan. I'll follow that content, put it out there. I'll be reading it quite a bit. So thank you so much for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our other podcasts on the Zephyr YouTube channel. And lastly, please follow us on the Zephyr LinkedIn page to learn more about Zephyr, and like and subscribe the Zephyr YouTube channel to get more great content like from Dan. Thank you, everyone, and have a great rest of your week.